Imagine trying to buy a car or a house while having excellent credit, and yet the banks still decline your application. Well, this happens to people every day because they don't understand the concepts of debt to service and loan to value. In this video, we'll cover what those terms mean so you don't end up in that situation. Okay, now let's talk about GDS, TDS, and LTV. Now, these don't directly affect your credit score, but these essentially are ratios and you'll want to consider them before making any major purchase. Now, GDS stands for gross debt to service ratio. Basically, let's say you're trying to buy a house. These terms typically come from the mortgage and the car industries. If you're trying to buy a house, your GDS, your gross debt to service ratio, is going to be what the payment of the house is divided by how much money you make per month. So let's say you make $10,000 a month before taxes. To calculate your GDS, you're going to take the payment of the house, so the principal plus the interest. You're going to add your property taxes on there and your heat. Now, air conditioning does not count in your GDS because that's viewed as a luxury. They're just going to want to see the payment of the house, taxes, and the heat. So if we make $10,000 a month, let's say our mortgage is going to be $2,000, keeping it real simple. Plus our property taxes is about $150 a month, and plus our heat is another $100 a month. That puts our obligation at $2,250 a month. If we divide that by the $10,000 a month that we make, we have a 22.5% gross debt to service ratio. Now that is just the house itself. Your TDS, your total debt to service ratio, is going to account for any other monthly bills you have, like your credit card, line of credit, car loan. So let's take the $2,250 a month that the house costed. Let's say we have a car payment of $500 a month. We have a credit card with the minimum payment of around $100 a month, plus a line of credit that's going to be $75 a month. That puts us at $2,925. If we divide that by $10,000, we're now at 29.25% total debt to service ratio, or let's say 29.3% or just under 30% total debt to service ratio. Now that's a very healthy range. Banks, if you're trying to buy a house, they're going to look at a gross debt to service ratio of 39% or a total debt to service ratio of 44%. You want to be under those thresholds. It doesn't matter how high your credit score is. If you don't have enough income to service the loans that you're applying for, you will simply not get approved. So you'll want to calculate your GDS and your TDS regularly before making any sort of major purchase. This way you know where you stand and you're not wasting your own time or a realtor's time or the dealership's time. You know that you can actually service a loan and afford to pay for it. This does not affect your actual credit score, but it is something you'll want to consider before making any sort of major purchases. And the last one is LTV, that's loan to value. So when you're trying to buy a car or you're trying to buy a house, there's a threshold of what the value of the asset is compared to how much money you can actually get loaned for it. Most major banks, when you're buying a house, they're going to look at an 80% LTV. That means that they will give you a loan. For example, let's say the house is worth $1 million. They'll give you up to $800,000 in a mortgage, which means you have to have $200,000 down to put on the house. The car industry is a little bit different. You can actually get a loan to value ratio of 125%. So you can actually take a loan out for more than what the car is worth because they're accounting for things like accessories, warranties, rust proofing, creditor protection. In the mortgage industry, it's 80%. Some banks will go higher, but that's going to be more of the B lenders, so not the major banks. You're going to be paying a higher interest rate. And also, if you do go above 80%, it's going to be harder to get the loan. You'll also need to get another thing called mortgage insurance. Now, that doesn't protect you. That protects the lender because the risk factor is higher if they go above an 80% LTV. So if you're buying a house, you want to have at least 20% down to keep the LTV at 80% or lower, and that's going to make your approval a whole lot easier. So if your GDS is above 39% and your TDS is above 44%, you can do one of two things. You can either lower your monthly payments by paying off some bills, paying off some loans, and that's going to drop your ratio, or you can make more money. So either you got to lower your bills or increase your income to bring that TDS to below 44%, and that way you'll be able to purchase a house a lot easier. I'm going to make a video on the 5 best jobs where anyone can earn 6 figures and higher. So get subscribed so you don't miss that video. Okay, little bonus information here. What is the highest credit score I ever saw while working as a financial services manager? One time, an older gentleman came in. He was buying a van. I was working at Chrysler at the time. He wanted to buy the car cash. I did my thing, convinced him to finance. His 2 sons were like, no. In the end, he went with the financing because I knew what I was doing. I pulled his credit. It was at 899. He was 1 point away from perfect. I showed this to my colleagues. We were all laughing like, this guy is gold. The credit gods love this man. He's a saint. $8.99. He was 1% utilization. After explaining to him the difference between buying cash, I told him, hey look, you can buy this car cash or you can finance it for 1 year with 0% financing. Keep the cash in your bank. I explained to him what the product was. The only thing it was going to cost him was a $50 lien registration fee. He said, you know what, Baz, that makes sense. I'll go for that. I pulled his credit, and when I saw that $8.99, my mind was blown. So you can have exceptionally high credit if you make all the right moves, pay everything on time. And then, of course, when I put in his loan, it got approved in seconds. System approval. He bought his van, kept his cash in the bank. It was an open loan, so he could pay it off at any time if he ever wanted to. But the reason why his credit was so high is because he understands credit, he understands financing. After our conversation, he definitely went with the financing. His sons came in, they looked through all the contracts and they were like, okay, this makes sense, let's do it. If you want to know exactly how to get an 800 plus credit score, then check out the video that I made about this. I'll leave a link to it in the video description. And then you can buy cars, houses, get business loans, and not have those roadblocks stop you from making the right moves in life. Credit is a very important thing. And think of it like brushing your teeth. It's something you need to think about every single day. Never let problems accumulate over time. Okay, that's it for this one. Make sure to hit that like button, subscribe, and we'll see you in the next video.